Well, joining us now is Larry Shover, Chief Investment Officer at SFG Alternatives in Chicago. Larry, hello to you. We'll come to the commodities space in just a moment. But firstly, just wanted to get your check on today's trade. We're seeing extreme weakness across those major U.S. indexes.
Yeah, I think we're making a huge deal out of it. It's just we haven't had like a 1% move in the S&P 500 since the middle of October, a long time. So I think really people just caught off guard, especially in morning trade. You know, your afternoon, the market was up a little bit. Oil was up. The dollar was flattish. And I think people just got jittery given the House vote on Thursday, maybe just naming an excuse for the fact that this market has rallied pretty far, pretty fast on a lot of nothing, as it were.
Certainly when it comes to the financial space, we're seeing what had been that real key sector off the back of that November 8 election result. Today, the biggest weight on those U.S. indexes. We're seeing the likes of Bank of America off by 6%, Larry. That's a huge amount. This, the biggest weight on the S&P 500. Goldman Sachs, yet another titan within this space, also moving to the downside. This must be a concern.
Yeah, it's a little bit of a concern. People talk about the yield curve and so fearful flattening. I tend not to look at the shape of the curve, but the direction of the long-term rates, and it's still pretty healthy. I mean, yeah, it's true. 10-year yield is backed up a little bit, down to about 2.42. Down about 10 bips from its high. However, it's still running much higher than it has been in the past 6 months. And I think there's a lot of weak hands in sector allocation. I do think bank overweight, global overweight makes a lot of sense. And I've continued to say that for the past probably 12 months. And there's going to be profit taking. And that's what we're seeing today. We could see a sharp wave of it going forward just because now, like, Pandora's box is open. People realize that maybe this is the beginning of the end. But I still think, you know, the financials, especially the big banks, have extremely good valuations and are a good long-term buy.
This also seems to be being tagged in with this move that we're also seeing in U.S. Treasuries, Larry. And again, investors seeming to be moving to Treasuries as that safety investment almost. Again, how are you seeing investors repositioning their portfolio, their asset allocation indeed, off the back of this move downwards?
Yeah, well, it depends on a lot of different factors. I mean, I believe in extreme diversification. But if you're a short-term investor, a short-term trader, I do believe like the the end-of-year yield for the 10-year would be about 2.3 to 2.4, actually a little bit lower than where we are today. But that does not mean that we're going to have a big stock sell-off. To me, it just means that the cost of money can't go up until there's some productivity going on, and we're not seeing that productivity. So I think the 10-year yield can back up a little bit. We can see it down as low as 2.25, 2.3 by the end of the year. But that said, I do think that it makes a lot of sense to have an extremely diversified portfolio with international stocks, domestic stocks, and fixed income.
So let's take a look at copper then. We're seeing it certainly moving, a disruption warning, I guess, coming through. Copper retreating, this as mine disruption eases. We are seeing that copper price really moving, hitting a one-week low off the back of those supply concerns in Chile and Indonesia. So not quite Dr. Copper when it comes to the health of the base metal.
Yeah, it's been a very volatile trade, and I think actually some of the inventory levels had been overstated in the market. I can't prove that, but it just seems that way. Right now, we're just seeing just a very illiquid market, at least from the professional standpoint, when we're talking about copper. And I think that's adding fuel to the fire, given the volatility that we have seen.
Certainly, we also see, as always, Asia being a real key player within this market. Another area where you're actually seeing Asia plays come into focus here is when it comes to steel. In fact, Larry, in your note this morning, you flagged that those China steel mines have become uncompetitive.
Yeah, that's true. I mean, it's been a very interesting trade. You know, the steel trade, when you look at inventory levels, they're still dropping, but yet the price is still holding steady. And to me, that's just telling us that there's still some demand out there, and demand is supporting the price. And until that turns around, then it'll change my trading direction in steel. We do acknowledge that iron ore basically continues to normalize, and stockpiles have normalized as well. But the steel trading has been very, very interesting, given the fact that people think that traders have just been selling, professionals have been selling, and that's not really the case. It's really been more demand on the inventory levels.
Well, in fact, I did want to ask you about this. When it comes to that iron ore pricing, where are you seeing the next support level being for iron ore?
Yeah, that's a tough question, but I do think short term, I almost don't want to make a prediction, because I could see it easily seeing a standard deviation of 10 to 15% over the next 3 to 6 months. But I do think the price will normalize, and we're going to be right within this trading range by the end of the year.
Let's talk oil then. Again, we've got these different factors going on here. Do you continue to see it being an issue, or is one move, for example, the US stockpiles in this instance, cancelling out the concerns that we have surrounding those OPEC cuts also, or is it continuing to be an issue in that broader sense?
Yeah, the oil price definitely it can easily become an issue. We do have to keep in mind that at this point that, global earnings, not just U.S. earnings, but, global earnings are positively correlated to the oil price. I mean, I like cheap oil, but the earnings in the stock market positively correlated. I'm not overly concerned medium term with the price of oil. I still think it's going to be higher than it is today by the end of the year. I acknowledge that inventory levels are dropping. OPEC is complying. It's going to be interesting to see what happens between now and May with the next OPEC meeting and how U.S. will respond to that. But what has helped all of this is actually the stability of the U.S. dollar, especially with the crude price. So it'll be very interesting next few months.
Larry, we had the commentary last week from the Saudi Arabia oil minister flagging perhaps even a 6-month extension when it comes to those OPEC production cuts. Can and do you see OPEC members really conforming to that idea?
I might be the outlier, but I think that they will conform more than they have in the past. And I think the environment is much different. The competition is stiffer than it has been before. That said, they understand that there's going to be a very quick response from the U.S. if the price gets too high. So I think they really are going to comply. They don't want to revisit what happened in 2014 and 2015.